Well, EU officials have warned the US that some provisions in the tax overhaul could violate some of its international obligations. They're concerned over the kind of impact the changes will have on trade and on European companies. China has also been keeping a close eye on these reforms. Saruhan Hatipoglu, the CEO of Business Environment Risk Intelligence and CGTN's Global Economics Analyst, joins me to break all this down. Welcome back to the show.
Good evening, Rachelle.
Now, it's interesting. The EU's top 5 economies are warning that this tax overhaul may violate international obligations. What are your thoughts on this?
Well, that should be left out to legal experts, really. But if you look at what the companies are going to be going through, foreign affiliated companies in the US, for example, that used to be able to get imports here, intermediate goods imports, and then deduct that as from their taxes at the state that they're operating, they will no longer get that. So the objective here from the US end is, well, you know, we're giving all this tax cut, and the states are going to be in trouble. Now the states don't have to pay for this, that they're going to be increasing their revenues, or at least keeping more of their revenues to themselves. And look, if you're a foreign affiliated company, you're coming here, maybe you should get American intermediate goods for your products. I don't agree with it. It completely goes against market demand and supply business. But that's the argument. Is it illegal? I'll leave it to the legal experts in terms of this specific aspect of it.
And do we know how potentially this could affect some of the trade implications? Now,
that I can tell you, there's a lot of illegal stuff going on, because the double taxation agreement with the EU and the US is going to be hurt by it. The US this tax bill is talking about a 20% excise tax on payments to the foreign affiliates. That is absolutely against the double taxation agreements with the parties. That's one thing. There's something called BEAT, Base Erosion Anti-Abuse Tax, where foreign affiliated companies would be through cross-border transaction, would be reducing their taxes. Now, this tax bill says, well, you're going to pay at least 10% on your tax income, but also from your corporate tax liability. Now, this is why Germany is very upset, because a lot of banks and insurance companies have been involved and providing assistance and finance to a lot of projects in the country. And now it's going to be retroactive. That means they're going to go back whenever that was in 2010, 2008, and they're going to be charged by that. The last thing, the worst one of it all, is 12.5% reduced taxes on companies that are selling goods abroad. You can't put all the lipsticks on this. It is an illegal export subsidy. WTO is going to be very busy next year.
Now, you mentioned Germany keeping an eye on this. What about China? We understand that they're also interested in what happens. Why would China be interested in the outcome of this tax reforms?
Well, China is trying to get foreign direct investment to the country. It's very important for them. And they're trying to prevent a lot of foreign domestic capital going to overseas. So they are worried, but they also need to do tax reform in China. You look at a private Chinese manufacturing company, they're paying 25% in corporate tax, 17%, up to 17% in value added, and then Social Security contributions about 40% of the average worker's salary. That's huge. That's not easy to compete. You look at World Economic Forum, Global Competitiveness Report, overall tax burden in China is 68%. That's 44 in the US, 49 in Germany, 31 in the UK. So China will need to address this. And some of this is already happening, but there's a difficulty. Let's remember that this is an aging population. They need to keep revenue coming in. So China is in a tough situation at this point.
Now, you advise clients all around the globe. What are you telling them to brace for as they're looking at some of the details of this tax reform unfolding?
None of this. I don't talk about this at all. They have great legal teams. They know what's going on. If they ask my personal opinion, I give it to them. What I'm worried about, Rachelle, is the biggest bubble out there in the global economy, and it's not Bitcoin. It is the $10.7 trillion worth of global bonds that have negative yields. Interest rates are increasing in this country. We have a tax plan, tax reform they call it. I don't call it that. It's a tax cut, massive transfer of wealth from the middle class to the wealthy, at a time when the interest rates are going up, at a time when the public debt in this country has risen from 60-some% in 2008 to over 100% now. My concern is that the interest rates are going to be increasing far faster than we're anticipating, and that is going to hurt the global economy as well as the US economy. But this is unfortunately not being discussed.
Well, there's certainly a lot to untangle. Thank you so much, as always, Saruhan Hatipoglu, our Global Economics Analyst and BERI CEO.